we were doing this analysis of looking at and this is why we are convicted on this strategy, is we're doing analysis of all the unicorn companies.
Yeah.
And the last round's valuation, the valuation 5 years ago, and then what we think, because we've met every single one, what we think the valuation of that company really is today. And what we found is 60% of the market cap is in the top 20 names. And 50% of the market cap is in the top 3 names of the entire unicorn economy.
That's
so
crazy.
All of those companies added up. And that's our view, right?
Yeah.
So you could take it our view versus the last round. They're slightly different, but the returns and the company sizes are very concentrated in the top 20. And so our view is we got to just be in the top 20.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers, the podcast where we talk to some really smart people who know software and tech. Today, I'm joined by Lucas Swisher, co-lead of growth investing and software investing at Coatue, to unpack how one of the most influential tech investors balances public and private markets, leverages data to drive decisions, and stays ahead in a rapidly evolving tech landscape. We're starting with Coatue's evolution, how the firm has grown from a hedge fund to a major force in venture capital, and how Lucas thinks about balancing short-term public market pressures with long-term private investments. Then we dive deep into data-driven decision-making, how Coatue's proprietary Mosaic platform gives them an edge where human intuition still matters, and how they guard against being blinded by the numbers. We also explore Coatue's investment philosophy, why they concentrate bets instead of spreading wide, how they win founders without flashy branding, and what red flags makes Lucas walk away from a deal even if the top line metrics look great. And of course, we look ahead. What's next for Coatue, the trends shaping the future of software, and how Lucas separates real AI innovation from the hype. Is it all sizzle but no steak? This one's packed with sharp insights on venture, growth investing, and what it really takes to back the next generation of software giants. All this and much, much more after a short word from our sponsors. Does your revenue recognition process feel like a total guessing game? Step right up and pick a card, any card. You're not alone. Revenue accounting is getting more complex, especially with subscription models, usage-based billing, and evolving compliance standards. Woohoo! RightRev is here to help you gain control over your revenue accounting. RightRev automates the revenue recognition process from end to end. Whether it's multi-element arrangements, subscription renewals, or complex usage-based contracts, RightRev takes care of it all. That means fewer spreadsheets, fewer errors, and more time for your team to focus on growth. Customers like Snowflake, Logic Monitor, and Epicor chose RightRev to manage their high volume and complex revenue accounting. CFOs can see the bigger picture faster without being held up by their team's reporting nightmares. You know me, I'm a business model fanatic. And don't get me wrong, I love all the evolutions. We've got self-serve revenue, usage-based revenue, and now even success-based revenue, you name it. But that doesn't make it any easier for us bean counters on the back end to keep score. RightRev is like a cheat code for staying ahead of revenue complexities. So you're ready to transform your revenue accounting? Visit RightRev.com to schedule a demo. That's RightRev.com and tell them your boy CJ sent you. RightRev, modern revenue recognition simplified. Oh yeah. Ready to plan confidently, close faster, and report with accuracy? Here's what sets Planful apart. Imagine purpose-built solutions for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks with minimal IT involvement, enabling seamless collaboration across your organization's key financial workflows. Best of all, Planful grows with you. Its unmatched scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Visit planful.com/metrics to see how you can elevate your team this year with Planful. They will hook you up. It is planful.com/metrics. Tell them your boy CJ sent you. Planful.com/metrics. Well, if you've listened to this podcast before, you definitely know that I think it's cool to be a fan of business. I'm obsessed with researching how the best companies operate and specifically how they manage their money. And I've learned that a company's financial stack can make the difference between world domination and obscurity. That's why I want to tell you about Brex, because I want you to rule the world. Brex is an impressive financial services and software company that has grown immensely since it was founded in 2017. In just the last year alone, Brex accelerated customer acquisition by 50%, with 91% growth in enterprise customers. And there's good reason that over 30,000 companies from startups to enterprises have flocked to Brex. Brex offers the world's smartest corporate card on a full-stack global platform that is everything CFOs need to manage their finances on an elite level. Plus, they offer modern banking and treasury, as well as intuitive expenses and accounting automation, bill pay, and travel. Wow, it's all on the roster whenever you need it. Brex grows with you. CFOs tell me all the time that Brex makes it easy to control spend before it happens, automate annoying tasks, and optimize their finances. Because listen, at the end of the day, Brex helps them make every dollar count. So if you're a fan of smart businesses too, check out Brex at brex.com/metrics. That's brex.com/metrics. Lucas, what's going on, man? Pumped to have you on the pod.
Thanks. Not much. Just dealing with the 17-degree weather in New York, which I was excited to wake up to this morning. And my dog, like yours, I'm sure, was even more excited.
Yeah, Walter's our mascot of the podcast. He sits by me the whole time, scratches me, and asks for biscuits when I'm trying to ask the hard-hitting tech and software questions.
I love that. That's a good time. I'm hoping that he wins more often than not.
He does. He wins a lot. I wanted to start with the basics. So what's under your purview at Coatue? How would you describe your role as co-lead of growth in software investing?
Yeah, it's a tricky question because it's something different every day. But at the core of it, I mean, I lead the growth business with my partner, David Schneider. Between us, we're responsible for everything from fundraising, which we do obviously with our broader team, to building the team and then finding the best way to invest and support our companies at the growth stage. And then I'd say one of the funny things about Coatue, and one of the, I think, great things, is we really work across the platform as well. So I'm also trying to help my partner Shri run the venture fund, and our colleagues on our tactical business, which is a slightly later stage business, help run their vehicles as well. But Dave and I, we run the core growth business day to day, and we have very different backgrounds, which is great. He comes from a career operational background, having been CRO at ServiceNow and Data Domain before joining us, and then I come from a career investing background. So we have a nice blend between the two.
And David Schneider was an advisor or was a board member, but he was heavily involved in Sneak, where I was a couple years back. And we used to look to him for operational insights based on like his kick-ass career at both Data Domain and ServiceNow, kind of the Frank Slootman lineage there.
Exactly. I mean, one of the funny things about us is, if you're looking for folks that have seen scale, both on the investing side and then on the operational side. Well, on the operational side, it's harder to find someone in the world than Dave, who built, ServiceNow's go-to-market team from 50 million to 5 billion of revenue, and from Data Domains from 0 to 1 billion of revenue. And then obviously we see many, many IPOs on the investing side. So it's a nice complementary fit that we have between the two of us.
Well, I want to dig into how your firm's investment strategy has evolved since its founding back in 1999, because based on your description, if I just play it back, Lucas, you're investing in probably a broader spectrum than you were at first. And you also have investment professionals, I think, who know what good looks like at all different kind of sizes along the way.
Yeah, I mean, we were founded in 99, right? At the peak of the dot-com bubble, and then obviously the burst and everything after that. And I think that's informed a lot of our DNA. And I think if you think about how we've changed, right, we've evolved a lot, and then we've stayed the same in some ways. So from an evolution perspective, I think that core starting point really informs a lot of what we believe, which is that markets change. And our view is that technology changes, and so should our firm. So what you'll hear if you talk to people that have worked at Coatue for a long time is that change is the only constant here. We think that technology markets are changing, and firms should change and adapt to the different waves that happen in technology. And I think the biggest way that we've probably changed is maybe twofold. One is how we interact with companies, and then two being the stage at which we've interacted. So when we were founded in 1999, we only interacted with public tech companies. But what we realized is over time, companies were staying public a lot longer, right? And so you couldn't buy, in 2010, you couldn't buy Amazon at $1 billion market cap or Facebook at $1 billion market cap. These companies were staying private a lot longer. So to do exactly the same type of investing that we'd always done, we launched a growth fund. And that growth fund really started investing in companies that were really at pre-IPO stage or maybe around before pre-IPO. And then over time, we noticed that the private market started changing too, right? If you get into the late 2010s, early 2020s, It wasn't just one type of capital that was in the market. Companies needed different things at different points in time. Sometimes you needed to be able to help an entrepreneur start the company in the first place with an incubation. Sometimes there was growth capital needed to scale something like Snowflake, where we participated in a growth round. And sometimes companies needed help with M&A or something that was really big. And so we've evolved the firm to be able to address any need that a company has. If there's a great entrepreneur with a huge idea, we've evolved the firm to be able to tackle every type of opportunity. You need help with a big M&A check and consolidating a market, we want to be there for you. You need $300 million to go hire the world's best engineers to keep building an AI platform, we can be there for you. We don't want to be dogmatic about how we approach the market. So that's how we kind of have changed over the years, is going from really like a point product to a true platform where we can offer all different types of capital to all different stages of companies. I'd say the one place that hasn't changed and that has stayed the same, and I think will always stay the same, is our focus on big ideas. We say that a lot internally. It sounds like a kind of a goofy mantra, but the reality is that's really what we're focused on. We have this, we call it a $10 billion test internally, right? Regardless of stage, can this company be a $10 billion company? And then when it's 10, can you imagine it getting to 50? So that focus on big ideas, I think, is the thing that hasn't changed throughout our history.
There's something to be said there about exponential thinking.
Yeah, I think so. I think we implement it in our business, right? You think about how we are always trying to grow and expand and change, right? I think one of the things over the last couple of years that's really got a lot of growth investors stuck in many ways is, hey, I only do Series Bs, or hey, I only do Series Cs. But we want to expand the way that we think and the way that we operate so that we can service and operate despite what's going on in any environment.
And so, like you said, you operate both as a public fund and a venture investor in the private markets. How do you make the growth stage private assets matter in a fund? And this is where we get into the weeds of like the economics of it a bit in the performance, when it's much more scalable in the public markets. And you can correct me if I'm wrong with that assertion in any way.
No, I think it's a really interesting question, right? But the nice thing is, I would say both of our businesses really matter. And I think the nice thing is, because of that vantage point on the private side, the reason that it matters is it gives us so many insights on what's happening for the public markets, right? If you think about the last few years in AI, a lot of the insights on what was happening in that broader ecosystem came from us seeing so much innovation at the early stage, right? And so many companies being created. So that private market really matters for the public. And then the inverse is also true, where I'll give you an example of a company that we invested in this year called Sierra, which is a data security company and a huge trend, fantastic founder. That was actually identified because we were looking at a couple public stocks, and on the earnings reports, people kept mentioning data security as a theme over and over and over again. So we started looking at it on the private side and mapping out the market, and then we found Sierra. And so I think that's how we end up mattering to each other in many ways. And then, from a purely economics perspective, these businesses are similar size, and our private companies, we hope, go on to be public companies in many ways. And so hopefully our positions that may start really small can become really large over time.
I love that. The information flows both ways. And it's kind of like you get a vantage point of either what something will become over time, or you can look backwards and try to take a theme and try to find something that applies to it within the private market. So that's definitely a synergy that if you were only investing in Series B companies, it's like to a hammer, everything looks like a nail. I think you get the opposite of that.
Yeah, it's a blessing and a curse in many ways, right? Because the aperture is wide, we can do anything. It's sometimes the challenge is to focus, but on the other side, right, it helps keep us from being myopic. We can, on the one hand, take lessons from history on what has worked, on what hasn't worked, and really apply that to today's world. And we get to see what's happening, not just in Series A's, but also in the public markets. And we don't have to choose between, that we can only invest at the Series B in a sales tech company. We could buy CRM, and be exposed to the same trend.
That's a beautiful way to put it. You could get exposure to CRMs, literally the ticker CRM or the software type through private or public. And something that I'm trying to square in my head is, with that broad of an aperture, how do you look at the short-term nature of public investing with the long-term patience in private markets, right? Like, because you kind of have to have a different mindset and a different probably stomach for time frames depending on where you're looking.
Yeah, this is candidly the most challenging part.
I bet.
Of having the aperture in both, right? Because the public markets are really finicky. On one day, the S&P might be trading at, 22 times PE, and it's, hey, we got to sell. And then on the next day, we may be buying because software stocks on average are below 4 times next year's revenue. And that type of, I can buy one day, sell one day, short one day, and going back and forth is really a day-to-day type of thinking. And obviously we try to make investments for the long term on the public side as well, but markets move and they change and they're dynamic, and we are very careful about risk on the public side of our business. In growth and in venture, but in growth where I spend most of my time, I think about it like I have one option, and it's a buy button. I don't get to ease into a position. I don't get to buy 10 million and see how it goes. My level of certainty has to be very high. I need to want to work with a company for a decade plus. I need to be willing to ride the company through a cycle, because it could go up tomorrow. It could be down 30% tomorrow in secondary markets or this or that. But that's the kind of certainty that we have to have. And I think a lot of the business is being steady and careful throughout cycles, and us maintaining that point of view inside of Coatue, right? That we are the steady ship that invests through cycles, especially when we don't have the sell button as easily as the public side does.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Trust isn't earned, it's demanded. Whether you're a startup founder navigating your first audit or a seasoned security professional scaling your GRC program, proving your commitment to security has never been more critical or complex. That's where Vanta comes in. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks, like SOC 2 and ISO 27001. Centralized security workflows, complete questionnaires up to 5 times faster, and proactively manage vendor risk. Vanta not only saves you time, it can also save you money. A new IDC white paper found that Vanta customers achieve $535,000 per year in benefits, and the platform pays for itself in just 3 months. Join over 9,000 global companies like Atlassian, Cora, and Factory, who use Vanta to manage risk and improve security in real time. For a limited time, our audience gets $1,000 off Vanta at vanta.com/metrics. That's vanta.com/metrics for $1,000 off. Here's a question. Do you feel like you're wasting time and energy on contract renewals or tracking shadow IT spend or, this is a bad one, explaining rising software costs to the board? Truth is, traditional spend management is broken. That's where Tropic comes in. Tropic is an intelligent spend management solution that consolidates your spend data and processes into one unified offering, enabling insights and decisive action. It doesn't just show you where the problems are, it helps you solve them. From spotting hidden optimization opportunities like duplicative spend to automating those painful procurement workflows to giving you the best market data that turns every vendor negotiation in your favor. I'm a Tropic customer myself. I've been using them for over a year, and I love their price checks. They allow me to see if I'm getting a fair market deal instantly. And I'm proud to say that I am no longer using my email as our company's contract repository. I've got every document and renewal neatly organized in my Tropic portal. Isn't it time to turn spend management into your competitive advantage? Visit tropicapp.io/mostlymetrics to see what's possible when intelligence drives your decisions. tropicapp.io/mostlymetrics. What does the future hold for business? Ask 9 experts and you'll get 10 answers. Bull market, bear market. Rates will rise, rates will fall. Can someone please just invent a crystal ball already? Until then, over 40,000 businesses have future-proofed their companies with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. Whether you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. If you listen to this podcast, you'll know I ask CFOs all the time to rep their tech stacks, and I would say almost every one of them use NetSuite. And that's what I would use too. Whether you're a company earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/metrics. The guide is free to you. That is netsuite.com/metrics. Ooh, yeah, it's netsuite.com/metrics. Please, guys, I really need this. Man, that is such a good way to put it, that you have a buy button. I want to talk about how you get to buy. And it feels like you at Coatue have applied the data-driven hedge fund model to the venture capital model, and that probably allows you to see the landscape a bit differently. Would that be a correct framing?
Yeah, I think in some ways it's a fair characterization, but I think there's like one other piece to it, right? We definitely spend a lot of our time thinking about how we can apply data to our business. We talk about it a little bit publicly, but we have a core platform internally that we call Mosaic. We have 30 data scientists and engineers at Coatue, and they spend a lot of time helping us figure out what's happening in the world around us. But there is another element that's layered on top of that in the private markets and in the growth markets, which is, I think the reality is that the core growth investing is a service business. I learned this at Kleiner from one of my partners, Ted Schlein, there when I was an associate working with him. Is at its core, what we do is we provide a service, right? We can use data as much as we want to our advantage in helping find a company and helping support our companies, but it's both finding them and evaluating them, but then also service. It's a service industry, right? You got to be able to, maybe the buy button was even a wrong characteristic in some ways. You have to be able to earn the right to hit the buy button.
Yeah.
And so that's what we spend a lot of time thinking is the data science, I think, and our engineers are absolutely fantastic. They help us understand what's happening in the world, where are things really growing, where are things going. They oftentimes test technologies for us, right? They used OpenAI before we invested in OpenAI. They used Databricks before we invested in Databricks. They used Snowflake before we invested in Snowflake. But then we have to get to buy.
30 data scientists and engineers. I just want to call it out for listeners because I feel like different firms differentiate in different ways. And that's like a core competency that you've clearly doubled down on.
Yeah, I mean, we spend a lot of effort on things. And one of the things that, we call out in our investing, right, is we want to invest in companies that compound over time, right, that have compounding advantages. And this is something we feel like we've really built with Mosaic and with our data science team, is a compounding advantage that we have. And that really helps us in our business across the spectrum. It helps our public teams, it helps our private teams, and it really enables us to source better, to evaluate companies better.
How does the Mosaic platform uniquely impact your perspective during due diligence? Is that where it comes into play the most, or is it more on the back end of figuring out how companies will perform over time given macro conditions?
Yeah, it's a good question. I think most of it is probably in that diligence stage and the sourcing stage. I'll give just a couple of examples. On the sourcing side, one of the ways that we think about the world is how can we use technology ourselves to be more efficient as a business? And so one of the things that we're looking to do is, how do we source more effectively? How do we figure out what's happening in the world in the most cost-effective and smartest and fastest way? And so we amalgamate basically every publicly available data source plus things that we've created in order to figure out what's actually happening in the world. And one way that I like to phrase it is we try to look inside all the houses and understand what's happening inside all the houses, which are companies, versus knocking on every door. We don't want to have a machine of hundreds of people that go and knock on every door in the country. We want to see inside the houses and understand what houses are growing and what houses are working. And so it really enables us on the sourcing side to chop the tens and tens and tens of thousands of companies in the US down to a certain subset that really probably makes sense for us on a variety of characteristics, qualitative and quantitative. On the evaluating side and on the diligence side, I think the place that it helps us the most is just humbling us constantly to history, right? If you think about just how many companies are created in technology that end up being massive, it's very few. And it's why we take a concentrated approach to investing. It's why we don't do very many deals every year. And our data helps ground us, right? Because if we're evaluating a new company and the net retention is this and the growth rate is this and blah, 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 it's very easy for us to comment and say, can this really have a ServiceNow-like outcome, or are we deluding ourselves? And so I think a lot of it is we mix the qualitative, all the qualitative, with grounding ourselves in the reality of what's actually happened in history to try to find really the anomalies of the future, right? What are the things that are growing faster than Now did, or faster than Snow did, or have better retention characteristics than Databricks? Those are really, really hard to find, but that's what we're looking for, like the new things, the anomalous things.
Yeah, and I bet there's also a component to coming up with theses on your own or hypotheses and then being able to test them. But like it came from the person and maybe like their qualitative assessment of the market, and then you're backing it up with data, because the risk always is that you just get blinded by the data and you follow that and you kind of lose the forest through the trees.
Yeah, 100%. I mean, by the way, there are great investors that are just ultimately data-driven investors, and I think it's certainly one strategy. But I think if you look at the best investments, they're not like the Uber for X or, the Salesforce for Y. They're things that are creating their own categories, and they're a new thing that's anomalous on some spectrum. And so I think you always have to do the data and the comping and understand, like, how does this compare to history? But then it's combining that with the qualitative, with understanding, like, where is the TAM arbitrage here? Or why is this person just outstanding and going to build something completely different and completely new, right? I think it's funny, like take OpenAI, for example, just as a case study. The old adage in software investing a decade ago was you don't invest in research companies. You don't invest in researchers,
Really?
right? Or people that came out of universities. You want to invest in people who've come out of operational backgrounds. And then the other adage that you learned as a software investor kind of growing up was you don't invest in other investors. And it's kind of ironic because in that case, it's a research institution founded by an investor.
Yeah.
And so oftentimes you have to learn when to break the molds on data and, comping and all these wonderful things that really do help with growth investing.
Well, also, like if you're investing in someone who's building something that's never existed before, because it's never existed before, it can't show up in a slide deck.
Correct. And you oftentimes can't put it on a spreadsheet, or it's very hard.
Right. It's an unknown or known unknown. I always confuse those two. Nonetheless, can you share maybe an example though where Mosaic may have revealed something critical that you may have missed and led to you saying, hey, we should make an investment decision?
Yeah, I think without giving like one specific example, I can give you like a category of examples because I think it's actually more informative, which is oftentimes we find ourselves in this position, and I think a lot of investors do, of being a little bit stuck and wanting to like something a lot, even when some signs are telling you that something is off or something feels weird. And oftentimes whenever we use the data in our data science to comp things or understand it relative to history, we can pretty quickly get to know. Because again, what we are looking for are the real exceptional assets that like don't fit on the chart of prior ARR curves in many ways. And so when we put something on there and it's right in the middle of a bunch of other companies, it helps us get to know really fast. And oftentimes for us, obviously the things we say yes to are the most important in many cases, but also it's what we say no to and what we spend our time on. And so it's like that nagging feeling that you have when you're looking at a company that's objectively an amazing company in many ways, but may not fit our framework of the next $50, $100 billion company. Getting it up and getting it in there into our system helps us get there a lot quicker. And I think has helped us avoid a lot of mistakes in the past.
The getting to know can be just as important. And you admittedly have to do that a lot more often than getting to yes and earning the right, as you eloquently said, to hit the buy button. You tend to be really concentrated in your investments from what I can tell from the outside compared to other companies. Can you speak to the level of conviction and how you go about creating a portfolio if it's less companies?
Yeah, conviction and sizing and concentration are really critical to us. And in my view, they should be critical to all growth investors. Because it's funny, we were doing this analysis of looking at and this is why we are convicted on this strategy, is we're doing analysis of all the unicorn companies.
Yeah.
And the last round's valuation, the valuation 5 years ago, and then what we think, because we've met every single one, what we think the valuation of that company really is today. And what we found is 60% of the market cap is in the top 20 names. And 50% of the market cap is in the top 3 names of the entire unicorn economy.
That's
so
crazy.
All of those companies added up. And that's our view, right?
Yeah.
So you can take it our view versus the last round. They're slightly different, but the returns and the company sizes are very concentrated in the top 20. And so our view is we got to just be in the top 20. And everything else, it's great. People are going to find ways to make money, right? I think, if you look at the next tier down, there are still amazing returns to be had in companies if you price it right and you hit it at the right time. But our view is the best returns are going to be finding those exceptional businesses and then doubling down in them over time and owning more of them over time. And so I think that concentration is just really important. And it's why that's really all we're focused on is finding ways to work with the absolute best companies. And, other folks are going to find ways to make money on the others.
That's a really great mental framework. Like just be in the top 20. It does cut through a lot of the noise of like, how much should I put on each investment? Like how many investments should I make per year? It's like, how do I just maximize or optimize my shots on goal to be in the top 20?
Yeah, I think that's right. And the other humbling thing, right? And the hard thing to do is you can say that all day long, but
right.
There are amazing companies and amazing founders all the time. And so holding that bar to, hey, I'm probably only going to do 1 or 2 new investments a year is really hard. It's one of the hardest parts of the job because like a lot of people, like I love technology, right? I grew up with it. I live it. I breathe it every day. And everyone at this firm and all over the industry feels that way too. And so saying no is hard, even when a company is fantastic. But it's, in our view, it's all about how do you get in and continue to invest and partner with the top 20.
Maybe to ask it a different way, do you think there are some firms out there who have a philosophy of we just want to be in the top 100 or top 1,000, and it's very contemplated, and they communicate that our returns, instead of saying 35% benchmark, and I'm just making that up, it's going to be 18 to 20%, and that's okay?
Yeah, I think there are other firms that do that, and they do it really well, and they have a different focus. And there are firms that have done that historically and made great returns. And I think the way that you can make great returns with that strategy is you pay the right price and you're really careful on entry valuation and you're better at maybe finding things than other people. So I won't name a firm, but I'll talk about a firm's strategy that I think is actually this, and I think they're really good at it.
Yeah.
The way that they operate is they have over 100 people on the investment team. They invest in dozens and dozens and dozens of companies every year. But they're finding things that other people can't find and winning those deals. And so they're able to get into companies at cheaper prices. And because of that, they don't have market returns. And they avoid a lot of the companies that we're in. Like we have very little overlap with this firm, but they have incredible returns and they do a great job. I think the problem and the people that get the most stuck are the people that are somewhere in the middle.
Yes. Can you say more about that?
Yeah, I mean, I think it's like, it's the firms that try to play both and think they're either experts at valuing companies or can play the like high price top tier asset game at the same time. It's really, really hard. I think you have to be very intentional about the strategy run. And if you get stuck in the messy middle, which is a little bit paying ultra high prices for not ultra, quality assets,
right,
then you can get stuck. And I think that's also the hardest part for one more reason, right? Which we're learning a lot about, which is liquidity, right? It's very well known at this point, but there have been obviously far less IPOs over the last couple of years. M&A is way down. And the assets that have the most liquidity are the top 20 assets, or they're assets that are getting sold to sponsors. And if you are stuck anywhere in the middle where you have a really good business, but it's not exceptional, oftentimes those companies are really stuck because they've had really high valuations. They can't go public. They have investors that have different incentives across the cap table. And so that's the place where it's tricky.
It's a messy middle. And I actually really respect people who would rather be consistently wrong and clearly communicate what the strategy is, because it takes all the guesswork out from both the GP's perspective and the LP's perspective. Like you know what you're getting, whether it turns out right or wrong.
Yeah, exactly. Yeah, it's hard. And the other thing that's hard is, right, this hasn't been a consistent theme in investment firms for a long time. I think certain funds have done it really well. You take Founders Fund and their growth fund. They've done this exceptionally well over the last few years, but a lot of growth funds are stuck in that messy middle.
And a lot of growth funds took on a ton of AUM, and then they were having to deploy it, I think, to companies that probably weren't the cream of the crop because they took on so much money. So like it almost exacerbated the problem of not knowing who they were at the time. No,
you're right. That's exactly what happens, right? Your strategy is dictated by how much capital you have in some ways, or it can be stretched by how much capital you have in some ways, right? And Our view is there's a really specific amount of capital that we think we can deploy in this strategy every year. And that's exactly what we're doing right now, right? It's not as much as some of the firms that have been raising over the last couple of years. I think when you get into fund sizes that are 6 billion, 7 billion, 8 billion, even 5 billion in some cases, you end up in a situation where you get stretched.
And there's not enough places to put it. Like you run out of cabinets to put the cash in. Eventually, to use a stupid kitchen analogy there, I don't know why I did that, but I respect where you're coming from, and also the ability to say raising too much money there can be a bad thing, because then there's the incentive to change the ball game to be like, oh, I'd make 2% on the management fee. This is like a capital, accumulation game, which some firms have probably shifted to over the last couple of years.
Yeah, I think that's right. And I think what you'll see from us is just steadiness on this, right? Like our goal is exceptional returns for our investors. And we'll raise different kinds of funds when our customers, which are companies, pull us in different directions, right? 2 years ago, one of the things that we saw is companies were coming to us saying, hey, I need capital to go fund M&A, but I don't want to use expensive equity for it. I need, a combination of debt and equity or debt. And I heard that, 10, 15 times from our customers, which are companies. And we said, hey, we can generate returns that are acceptable to LPs. They're slightly different than what we shoot for in our growth investing, but are a different capital structure that provides more structural downside protection. And we can fill a market need that, in our view, accelerates over the next couple of years, at least. And so for us, growth doesn't look like trying to scale the growth business, which I don't view as scalable at all. Our growth is outward, right? It's running great strategies in different parts of the market, in different capital structures, where that's how we're going to grow as a firm.
The way you describe it, going from a point solution to a platform, does remind me in a lot of ways of the tech companies that you invest in.
It's funny, like we try to eat our dog food in a lot of different ways. Part of it is, that's why part of the reason why we have 30 data scientists and engineers internally is we dog food a lot of the technology before we invest in it. A lot of the, SaaS applications that I've invested in, things like Glean, I use them internally. We use them internally before because we want to see how we feel about this product. And the nice thing is it's not just application software, right? We can also do that with infrastructure because we have this big infrastructure that we built. We also do that from a business building perspective, right? Which is our view is we should be the absolute best at every product that we offer, both to our LPs and our customers, which are companies. And we demand that of the companies that we work with, right? Those are the types of companies that we love. It's, companies like Rippling that expand their product set constantly, and they were built and born that way. And that's kind of how we think about our own business too.
We had Adam Sawicki, the CFO of Rippling, on the podcast. Out of the 140 episodes we've done so far, his has the most listens. So
that makes total sense.
Yeah.
Company is fantastic.
Yeah. Hey, I have this weird theory, and you can push back, that all investment firms are really companies that do something else but just monetize through investing. So to give you an example, like Signal Fire is really like a business intelligence platform that instead of selling software, they make money through investing in software. Or like another weird example would be like Insight is like a biz dev company that can help you sell into their 400 portfolio companies, but they monetize through investing in other software companies. Andreessen Horowitz, I think, is a media company that happens to monetize through VC. Is there any truth to this wacky theory?
I think what you're getting at is firms that are great differentiate, right? They offer one thing or two things that are like very different than their peers, right? Andreessen, as you mentioned, they do a great job with marketing, and also, right, they have big operational teams that really help.
Yeah.
Insight has a big biz dev team. You're absolutely right. Other firms do things like Signal Fire's data science team is fantastic. And I think the great firms really do try to offer one or two things that are really different. And so for us, right, the two things are, we are, in our view, the kind of call it crossover, call it public and private platform firm that really understands the public markets and has a global aperture on what's happening in technology, from the very earliest stages to the very late stages of being a public company. And then we're active on your board, right? We are active investors. We don't play the index game. And what that enables us to do is the second thing that we really care about, which is solve big problems for companies, right? We don't want to solve the small problems. Like, we think other firms are actually really good at that, right? There are firms that are much better than us at helping companies hire engineers. Andreessen is really good at that.
Yeah.
You should take Andreessen on your cap table for that, for those skill sets, right? For the marketing skill set in those. For us, it's combining this like global investing aperture and being able to connect you with really anyone globally because of where we sit in the world with our operating partners, right? And those operating partners are not like a tier 3 person. We have a few, like most things that we do, a few that are exceptional and can help you with a big problem. You know, Dan Rose, who ran strategy at Amazon and Meta. It's Karen Maroney, who ran one of the most successful branding and comms agencies in Silicon Valley, and helped Mark Benioff from the early days with his branding. And it's Sri Viswanath, who was a CTO of Atlassian. So if you have a technical problem, it's hard to find someone who's better at that than him. So it's combining those two things that I think make us really good, right? And I think the best firms have that.
Yeah. I think Tiger's competitive differentiation is they'll invest and then they'll never email you again. That came from me, not from Lucas.
And listen, by the way, some founders really want that.
Yeah.
I mean, people want different things, and that's kind of the beauty of it. And it's our job to figure out, is what we're doing good enough?
Well, it's funny because at the end of the day, like if you skinny it down, you're selling cash, and cash is a commodity. And it's like, how do you differentiate something that is money be green, right? It's all the same at the end of the day. How do you make it better?
Yeah, that's right. I mean, it's why the way you describe it is apt. We are investing companies, money givers, but we're wrapped in something else. And I think it's you got to pick what you want. And I think what we've tried to do is tailor what we offer to what our customers really want, which is help with big transformational things, right? At the end of the day, like, we work with companies that we think are going to be the big transformational companies. We got to be able to offer something that they're going to want. And so far, it's worked really well.
So I want to shift to talk a bit about unit economics, because you know what great looks like in the public markets. And then you also try to pick those who can get to that in the private markets. So how do you evaluate the sustainability of a software company's unit economics when it's smaller, if you're trying to get it to that point? Like when you jump into a data room, what are you looking at first?
The unsatisfying answer is it really depends.
Okay.
Just because there are so many different types of software companies, but I'll give a couple of examples. And I think there is one overarching metric that is the most important in my view. And my first boss, Richard Wells at Insight, it's where I started out of college. His number one thing that he would always look at is gross retention. And gross retention, which is effectively, inclusive of downsell and churn, how many dollars do you keep from a customer 1 year later after you start with them, right? That customer or that gross retention number, for me, is the most important because it means what you're doing is really critical. And if you look at almost in software, if you look at almost all of the great platform companies of the last generation and really any generation, you're hard pressed to find big ones without fantastic gross retention. They don't exist. They don't exist. You look at the $50 billion plus category, the CRMs, the Workdays, the Nows, right? Those companies, they all have great gross retention. And so that's the number one thing that's like, it's an absolute deal breaker. You cannot invest in companies, in my view, with low gross retention. That being said, there are different kinds of gross retention for different kinds of companies.
Yes.
If you're looking at a core system of record SaaS company, it's really easy. If you're looking at a productivity tool where you might have a free usage tier and a pro usage tier and a Teams and an enterprise usage tier, by almost definition, you're going to have different retention characteristics. So I think it's about both understanding the metric, but then also understanding that like great companies, things can be different and change, right? I think a lot of people early on would have looked at Canva's gross retention, for example, and said, oh my gosh, we have a problem. But if they said that, they were looking at it the wrong way, because they weren't looking at the gross retention of the enterprises. They were looking at the gross retention of the users and maybe the free users, right? And so these dynamics really matter because Canva's retention on a customer basis is fantastic, right? It matches up with the best of the systems of record in the public markets. But they have basically used the free tier as a marketing funnel, right, for the rest of their business, which makes CAC really low for them and enables them to really fuel this beautiful flywheel that they've had for over a decade now.
Mark Andreessen has this quote that's so true, but also so unhelpful about product market fit. And somebody asked him, how do you know when you have it? And he's like, you'll know when you have it. And it's like true because you can just feel the market pulling you. But if I was to try to quantify that, I think I'd have to agree with you that it's gross retention.
Yeah. Do people use what you have day in, day out? And do they use more of it every year?
Can you speak to the differences in evaluating something like enterprise SaaS versus consumer software? How does your approach differ? Like, do you just have to like go into the other room and like reset your mind before you look at the benchmarks?
The answer is yes. The context switching is I think really critical. I think that the one similar, they're very different, right? And they have different metrics. And in SaaS you might look at gross retention and net retention and all these wonderful things, and in consumer, you're going to look at CAC to LTV and, what do I think the TAM is and what are the number of users and what's the ARPU and all these different metrics. But I think at the core, the thing that stays the same across both is, are you in a really big market that you feel like is naturally expanding and you can layer new products on top of, right? And that's our view of like what really builds a platform company. One of those top 20 companies is, do your customers love you? Are you growing with them and you're in a virtually unbounded TAM? And then are you a business that can add new things on top of it and expand that TAM? And then, is it a big market at the end of the day, right?
Yeah.
And do your customers love you?
And it goes back to that, not to negate all the smart stuff you just said, but earlier in the pod, you mentioned, can this get to 10 billion? Like regardless of who you're serving as your end customer or what market you play in, can you build this business to a magnitude of scale that you're like, okay, this starts to make sense?
Yeah, exactly. And it's funny, like we talk about this with our public market team all the time because their view is 10 is small, right? A $10 billion company is small.
Right.
And so their push to us, which is right, and it's actually really helpful a lot of the time, is not can you get to 10, but can you get to 10 and then do I want to buy your stock? Right. And that's how I think about it a lot. And I run a lot of my ideas by our public market team, because really what I'm trying to figure out is, if this company works, does my public team 5 years from now want to own the stock? And if they don't, then I need to have a really good answer why they don't and why they're wrong and why they will actually want to own it.
Because there's always that next buyer scenario you have to play out. Like you can't get out unless somebody gets in.
Yeah. And it's funny. This is the other thing where I think a lot of growth investors and investors in general get tripped up, right? Is they're like, well, I have this awesome business. It's 300 million in revenue. It grows 30% and it's break even. I should be worth X.
Yeah.
And it's just not true, right? Like at the end of the day, markets are markets and you have to find a buyer for the stock. And that's oftentimes a really hard thing, right? And it might be because of the market they're in or the trend they're in, or there's a lot of competition in this segment or whatever variety of thing there is, right? And so that's the tricky part, is how do you, and I think that's actually a lot of what, the value that we give to our LPs, right? At the end of the day is like differentiating that. What will someone want to own for a really long time? What do I want to own for a really long time? What do I want to like put in a trust for my kids and never think about it again? Those are the types of companies that we're looking for.
I like how you brought up too, Lucas. It's like a SaaS CFO and CEO of like a 20 or 30 million ARR company, say in vertical software, comparing to like another vertical software like Procore or like Guidewire or Service Titan, who's public, and being like, well, I should get that multiple too because I'm also growing 30%. It's like, no, they're growing 30% at like $1 billion in revenue. Do you know how hard that is to get to? Like, it's not like you can just rip and replace one multiple and put it in the other, absence of scale. Doing stuff at scale is really hard.
Really hard. And like the other thing is proving it over many, many years is really hard.
I forgot about that. Yeah.
Reliable and like hitting your earnings every quarter for 10 years. I mean, like that is valuable, because then a public investor can sit there and say, hey, if I'm sitting at a long only and I'm an analyst, I can say, hey, I can buy this and I'm definitely not getting fired. Right.
Yeah.
And so there's that whole other element to it too. But the flip side is maybe that 20, 30 million ARR business is actually going to be better for a number of reasons. And like, that's what I'm the most interested in, right? Is like, where can I actually assign a higher multiple so that I get to win the deal and I get the arbitrage of feeling and having reasons for why it might actually be better than Procore or Guidewire or Viva or, whatever's come before.
As an operator out here shilling companies, no, I'm just kidding. I like that perspective better because it does give you confidence to perhaps buy ahead by 6 months or 12 months, because at that level, you're like, yeah, I'm overpaying now, but I think that this is going to be massive, and that's arbitrage.
Yep.
Maybe gearing towards a close. I mean, you had hit on it. Coatue's reinvented itself several times. So if you had to bet, where would the firm's structure or strategy look like, let's say 10 more years from now?
Yeah, I think what you'll see from us is continuing to evolve our business aggressively, right? I love the mantra that we have, that the only thing that stays the same is change. And I'm really excited about that. It's something that I love, is being able to adapt and change to the environment while keeping a steady ship through different cycles. I think what we will evolve to is we want to help entrepreneurs with bigger problems over time, right? We're getting bigger. Our aperture is getting bigger. Our network's getting bigger. The amount of companies that we're invested in are getting bigger. How can we help with bigger problems that we don't help as much with today? And I think we're going to be entering an interesting cycle in the private business where there's going to be a lot of consolidation over the next couple of years. So how do we staff our firm the right way to be the number one resource that people can lean on for, one of our platform companies to go buy, something that's adjacent to them? And that requires a different muscle. We have a lot of M&A muscle internally already. We've seen a lot of this, but how do we build our bench so that we can really offer that as a service? And then I think what you'll see from us is keeping our teams lean on the investing side. Because again, our view is you do not need tens and tens and tens and dozens of investors that are career investors, but you'll see us leaning into the operator side and not necessarily hiring teams and teams, but continuing to build out that bench in people that are the best at what they do, who want to work with the next generation of platform companies, fantastic companies, and really doubling down on those two things, because I think that's really where the business is going.
I know it may differ, but if there are companies who are looking to get in bed with an investor and they're evaluating what the differentiators are, what do you think is like the top quality to look for? Like maybe in the growth stage, just to narrow it down for you. Is it like someone to help scale sales and operations? Is it like someone to help you recruit engineers? Like, is there a quality or a characteristic that you think is most valuable in that area?
I think you need different things at different points in time, right? That's kind of the funny thing, which is, I think there are firms that at the early stage, maybe the most important thing is helping you find a co-founder, right? Seriously, at the end of the day, like there are people that are amazing at linking up co-founders, and maybe that's what you need. At our core stage, I think oftentimes what people really need are two things. One is help on go-to-market,
okay,
right? Like oftentimes they've got, at the stage where I play, oftentimes people have something that's already working. It may not be perfect, but it's already working. And the question is, how do I hire 100 sales reps in a quarter in order to scale the thing? And that requires somebody who's done that before and been there before and seen the pitfalls around the corner. And then I think the second thing is, which is, in my opinion, equally important, is understanding how you expand your TAM and what TAM expansion has looked like historically. Because oftentimes companies that have product market fit early on can really get sucked in on that one product. It's hard, right? Like you look at your company, it's screaming, it's growing so fast, but then they penetrate that curve without building the second S curve and the third S curve and the fourth.
What do they call it? Jumping S curves?
Jumping S curves. And somebody who's been amazing at this is Ali from Databricks, right? He's jumped S curve to S curve to S curve to S curve over the last 4 years. But like I think you want an investor and a partner who's really seen that again and again and again and knows how to help understand where the puck is going and how to naturally expand TAMs over time.
Last one I got for you, Lucas. You've done pretty well. You've picked some winners. If there's one lesson or philosophy you'd like to pass on to the next generation of investors, what would it be? Yeah,
it's interesting. I'll actually give one tidbit, which is the tidbit that I got my first day in the business.
Yeah, go for it.
Which is over a decade ago at Insight. There's a partner, Ryan Hinkle, there who had all of the interns in a room whenever I interned there my junior year of college. And he gave this advice that, like, he said he's like, this summer and in the future, every second counts when you're starting out. Every second counts. Every second that you're not doing something, someone else is. It's an intensely competitive business, and you have to be willing to do the incremental thing that someone else is not. It's the being in office the day before Christmas.
Yeah.
It's the, what he advised me to do, which was work over the first holiday. And I think being willing to outwork, to be faster, be more creative, to do that incremental thing has really paid off for me over time. For better or worse, we're in a business where inputs don't always equal outputs, but you will not get the outputs without the inputs. And so it's something that has really, that that piece of advice, I think, really changed the trajectory of my career, and hopefully it does for other folks as well.
I love that. And I've heard people say, like, the higher up you get, you're only measured on the quality of your decisions, not the amount of work that you put in. But I always say, like, you need to put in that work in order to make the good decisions. It's not like a one or the other thing.
Yeah. And it's, I mean, again, right? Like the businesses we love, people's careers compound, right? Or good careers compound. And the only way you get there is inputs.
Yeah, there's an element of preferential attachment too, where if you can get some quick wins, you keep stacking those wins. It's kind of like you're almost jumping S curves in a career in that sense.
That's true, and it's not always guaranteed, and you kind of constantly be willing to change. But it's a tricky dynamic.
Absolutely, Lucas. This has been a blast. Thanks for taking us into your world. I appreciate all the insights.
Awesome, man. Thanks for having me.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.